Triton Inc. is comprised of 7 members: Jeffrey Day, Director of Operations; Jeremy Ibara, Director of Accounting; Ruben Juarez, Director of Finance; Stephen Lamb, Director of Marketing; Johnny Pham, Director of Sales; Vincent Tam, CEO; and Patrick Wang, Director of Human Resources. In a simpler form, it is the mission of Triton Inc. to provide everyone and everything a sustainable and quality product to make life better. Committed to helping the human race, we believe in people and operate to grow and stay for generations to come. Triton's goals and objectives include becoming number 1 in market share and unit production cost. Return on equity is also very important, as there are 4 points in that.
Hello, my name is Ruben, and I will be talking about goals and performance targets. So our first performance target is market share. So in year 5, our prediction was 25%. In actuality, it was 24.69. In year 6, it was 27%. And in actual, it was 26%. So market share was in line with our forecast. Next was unit production costs. We had a prediction for year 5 of $3.20 and actual of $3.67. In year 6, we had a prediction of $3.10 and actual was $3.77. Unit production cost was one of our top weighing factors. We believe that we were below expectations, but we made it up in different financial factors. Next is our stock price. We predicted a stock price of $1.50 in year 5, and in actuality, it was $2 in year 5. And we predicted $1.95 in year 6, and the actual for year 6 was $2.32. This was a category our group was above expectations. It was due to a strong buyback plan starting in year 5, quarter 1. It was to make up because we had a low dividend, so we decided aggressively to do a stock buyback plan to raise up the stock. Next, it was total net income. For year 5, we had a prediction of $6,250. In actuality, we had $3,142. In year 6, we had a prediction of $6,500. In actuality, we had an actual of $5,255. Was return on assets. We had a prediction for year 5 of 10%, and we had an actual of 15.75. And in year 6, we had a prediction of 10%, and in actuality, it was 24.28. This was also another category our group was greatly above expectations. And next, we had return on equity. So we predicted in year 5 we would have 15%. We were actual 21.6%, and in year 6 it was 17%. In actuality, it was 31.73%. So this also was another category our group came over expectations.
Hi, my name is Jeremy. I will be discussing the marketing, operational, and financial strategies of Triton Inc. Triton Inc.'s plan is to invest heavily in advertisement. Buying the consumer preference report early in the game to figure out what customers wanted was a big part of strategy. To dominate first in our home plant area in America 3, and then to take advantage of struggling companies to increase our market share. We would then pour large sums of advertisement into these areas and lower our price to make it more attractive to consumers. Our operational strategy, our long-term vision, and investing in livestock to have the lowest unit production cost. Operation being the lowest price and being the lowest cost leader was one of our strategies. Also to our scheduled production lines according to forecasting our sales. Triton Inc.'s financial strategy was to borrow money in the beginning to make huge investments. We knew our strategy was going to pay off, so we borrowed money to make money. Getting cash flows and net income at a high level was the objective, and then we could repay bonds and bank loans. We would then buy back stock and increase our dividends. And now I will hand it over to Steve to discuss the reasons for success and failure.
Hello, my name is Steven and I'll be talking about the reasons for success. First off, we believe we had a very effective marketing and advertising campaign. Of all the companies, we spent the most money on advertisement. We really valued that aspect and kept a large budget for it. Second, we entered vulnerable markets. When our sales numbers were competitive in other areas, we chose to focus there. Based on our quarterly results, we noticed weaknesses in America 1 and we thrived in that area because of our unit pricing and advertising. In Nistock, we led the industry with lower pricing and we were leaders in the market share. Third, we protected the home market. In America 3, no group was able to enter and compete. Our company began without competition in our area and we kept that advantage all the way through. Maintain strategies and goals. Our goal was to continuously be the low-cost leader. We observed the industry and their pricing and adjusted accordingly. Financial strategies. We took loans early and chose to invest in an overseas plant in Nistock. That allowed us to build up cash reserves. In year 5, we were able to pay back bonds and bank loans. We were also able to buy back stocks and increase dividends, which resulted in skyrocketing stock prices. A reason for failure is our inability to gauge and match the consumer demands. We were unable to correctly forecast consumer demand. Stockouts forced us to reopen previously closed lines in our home plant, which drove up our unit production cost. At the end of year 6, quarter 4, our inventory was nearly wiped out as we stocked out in America 1, 2, and 3.
Hello, my name is Jeffrey, and I'll be talking about the variances in our statements. First, I'll be discussing our income statement variances. As you see here in net sales to customer, we had a variance of 34%. Because of our sudden increase in demand for our product, we did not expect our actual sales to customer to be about 32 million, which only had a variance of 8 million. We had reopened 2 lines in America 3 and also had second shifts. And obviously with reopening lines in America 3 and having second shifts, our cost of goods sold would also increase, which had a variance of 31%. And while only looking at those 2 numbers, which are a big part of gross profit, you can already get an idea that our gross profit variance will also be significantly different, which had a variance of 37%, which is equivalent to about 5 million. In regards to sales commission, we wanted our salespeople to be compensated for their hard work and their performance. Here at Triton Inc., we value our salespeople and want them to be compensated for their great work. Regarding transportation expense, we had a variance of 36%. The reason for that was because of Nistock. With our overseas production factory being a great benefactor in our production, we would have them ship out orders to Area 1 and in Area 2. In regards to research and development, R&D, which had a negative 91% variance, the group and I decided that we would use the money that we would invest in R&D in other areas in order to have a better outcome for our company, because we already knew that we were not going to produce the next model by the end of year 6. And in regards to storage expense, as I said, we did not expect to produce a great amount of sales throughout year 5 and year 6. And because of that, we had a negative variance of 72%. Next, I'll be talking about our cash flow statements variances, which is interest paid, tax paid, and stocks repurchased. Throughout year 5 and year 6, we made payments to buy back bonds and stock, causing our interest paid to have a variance of negative 55%, as you see here. In regards to our taxes paid, as I mentioned earlier, we had stocked out numerous times, and the demand for our product was very unexpected, which has have a variance of over 250%. In regards to our stocks repurchased, which had a variance of 181%, we decided decided to increase our stock price in order to beat our competitors with our weighing factors. In the weighing factors. Finally, our balance sheet. I will be talking about our cash balances, our net manufactured equipment, and accumulated earnings. Our cash balance had a variance of 31% because we had to reopen 2 lines in America 3 and create a second shift in order to compensate the high demand in our product. When looking at our net manufacturing equipment, which had a negative 37% variance, and for our accumulated earnings, which had a variance of 92%, while looking at our numbers from the previous statement, and how I said that our sales have been highly unexpected, you can already get an idea that our accumulated earnings will also have a high variance, which was over 15 million.
Alright, so I'm going to be talking about our SWOT analysis. Start off with our strengths. The first strength is market share. We have the second highest market share due to our low price and high budget for advertisement. Our second strength is large sales force. With the large sales force, we're able to handle problems quickly and make more sales. The third strength is differentiated strategy. We use consumer reports to find the best product for the area. The last strength is our unit production cost. We have the lowest unit production cost without sacrificing quality and features due to our overseas plant in iStock saving us money in labor. The second thing I'm talking about is weaknesses. The first weakness our company has is forecasting accuracy. Since year 3, quarter 1, we've been having trouble forecasting our sales, which has led to stockouts and misplaced inventory, causing storage cost increases. The second weakness is operating 2 plants. Operating 2 plants has been a hassle for us because we couldn't manage both of them. Our iStock plant was behind schedule, and we invested too much in our America plant, which led to high expenses during certain quarters. Our third weakness was storage costs. Because we were afraid of stocking out, we placed a lot of inventory in all our areas, which increased our storage expenses to avoid stockouts. Our last weakness is transportation costs. We had high transportation costs because we only have 2 plants, one in America 3 and one in iStock, and we had to ship all our products to America 1 and America 2. The thing I'm talking about is opportunities. The first opportunity is attracting new investors. We will attract new investors due to our high stock price and high net income, which investors love. The second thing is globalization. Currently, we are selling in only iStock in America, but we plan to sell in more countries in the future. The third opportunity is expanded training to employees. We will continue training our employees to make our plants more efficient so they can create our products quicker. But the last opportunity is lower production costs. We will lower our production costs by continuing our expansion in iStock and use all their lower labor costs in iStock. The last thing is threats. Our first threat is shortage of cash. In certain quarters, we've overspent, which has led to financial difficulties for our company. In one quarter, we had to take out an emergency bank loan due to overspending. The second threat is price elasticity. The price of our product was too cheap at some points, which caused us to lose a lot in net income compared to our competitors. The third threat is change in consumer preferences. The consumer changes what they like quarter by quarter, so this might affect our product's sales. The last threat is competitors producing in iStock. Currently, our company is the only one producing successfully in iStock. Once our competitors catch up, we won't have that advantage anymore.
Our company has future plan in marketing strategy, in areas such increase in advertisement, and also improve product qualities. Over the year, we planned to open more lines in iStocks, and in addition, we want to hire more workers in iStocks. We try to reduce lines in area 1 and area 2. For the operational strategy, we try to maintain the same quality performance in our home area, America 3, and then also in our overseas area, NASDAQ. We also want to lower our cost to against our competitors, and in the same time, we maintain the good customer services, and we want customer loyalties, and then hope they can bring new customers. For the financial strategy, our goal is to increase in revenues and growth in earnings. We already have 25% market shares at the end of the year 6. So we want to keep at least 25% market shares and raising our stock price. In the meantime, we want to increase our profit margins.
Hi, my name is Johnny, and I'm going to go over the lesson learned slash mistakes and also the decision making process for our company. So, like many other companies, we had our own fair share of mistakes, but we use it to our advantage and learn from it. One of the lessons we learned was the importance of forecasting. Forecasting is to predict or estimate a value for the future. Starting year 3, we failed to forecast our sales correctly, and it caused many problems for us down the road. We stocked out in a couple of areas and caused us to lose customer loyalty. This made us having to spend more in advertising to help win back our customer from our competition. Secondly, another important mistake we did was product pricing. We decided to be the cheapest product to gain more sales, but did not account for the differences. At one point, we sold many more products than our competitors, but made the same amount of net income. A low profit margin means there is little funds available for profits and to cover expense. That put the saying that every penny matters in our heads, and we adjusted to the mistake. This led to our company to be the most profitable out of our competition. Because of our fixed price, we were able to reach our goals. Lastly, we learned that managing our money is important, but to not overspend. In a couple quarters, we overspent on advertising as well as doing too much at one time. An example is opening 4 lines in nice stock while increasing our other expense. This caused us to be financially constrained for a couple of quarters. One quarter, we even had to take out emergency bank loan at a high interest rate because we overspent. The reason behind the emergency bank loan was that we did not calculate how much it would cost us to buy back 500,000 shares of common stock at around $3 per share. This hurt us by increasing our credit rating and losing some of our investors. Our decision making process consists of group meeting at least twice a week. Usually step 1, we identify the decision to be made. We realize that a decision must be made and then go through an internal process of trying to define clearly the nature of the decision we must take. The first step is very important. Step number 2 is gather relevant information. The real trick in this step is to know what information is needed in order to make the best decision. This step requires involvement of all group members. Step number 3, identify alternative. Through the process of collecting information, we will probably identify several possibility, path or action or alternative. We may also use our imagination and information to construct new alternative. In this step of the decision-making process, we will list all possible and desirable alternative. Step 4, choosing among alternative. Once we have weighed all the evidence, we are ready to select the alternative which seem to be best suited for our decision. We may choose a combination of alternative. And step number 5 is review decision and consequence. In the last step, we analyze the result of our decision and evaluate whether or not it has solved the need we identified in step 1. If it has, We may stay with the decision for some period of time. If the decision has not resolved the identified need, we may repeat certain steps of the process in order to make a certain decision. We may, for example, gather detailed or somewhat different information or discover additional alternative on which to base our selection. Usually, we do not have any conflicts in our decision-making process, but working with 6 to 7 other people with different background and experience in the respective field may have caused some different point of view. In this case, we would submit a alternative decision and take a group vote. And that's conclude our presentation. Thank you.